Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Pillar 2 to the EU's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. Check out PwC's Policy on Demand news platform that provides in-depth insights and analysis on tax policy developments. Policy on Demand is now available for free at policyondemand.pwc.com. On this week's episode of Cross-Border Tax Talks, we're at PwC's Global Financial Services Tax Leaders Meeting in Paris, France, where I'm excited to have Will Morris back on the podcast. Will was recently named PwC's Global Tax Policy Leader, replacing Stef van Weeghel, who retired after a distinguished career with PwC. Will, congratulations and welcome back to the podcast.
Thank you, Doug, and I'm delighted to be here.
All right, so let's start with Stef. Stef was the PwC Global Tax Policy Leader and was with PwC for almost 15 years. He's an international tax professor at the University of Amsterdam and has served both the International Bureau of Fiscal Documentation and the International Fiscal Association, IFA, as we like to call it. Any departing thoughts for our dear friend, colleague, and partner Stef and his contributions to the world of international tax?
Well, yes, just speaking for myself, trepidation at stepping into such big shoes, but also gratitude to Stef for what he's done. I've been at PwC only 6 years, but working with Stef has been a huge privilege. And he's a legend in the tax field. And he is also he's the embodiment of good sense, courteousness. He's been a wonderful colleague, and he's not disappearing from the tax world. As you said, he'll still be a professor at Amsterdam. So Stef it's been great working with him.
Yes, very measured, and really since I've been in this role for a little over a year now as the global ITS leader, have learned a tremendous amount from him, and even before then, and I've always appreciated his wisdom and his measured guidance in the field of international tax. And you're absolutely right. He's not quite giving up international taxation, but we'll be moving on from PwC, and we certainly wish him the best. All right, so let's dive into the material. And Will, this is an area that I'm convinced is not getting enough attention for international tax professionals across the globe. There's just a ton going on in the world of international taxation, and frankly, a lot of things are getting lost in what I'm calling the current of Pillar 2. And we've certainly dedicated a lot of time to Pillar 2 on this podcast, and frankly, I'm excited to explore another issue outside of Pillar 2, although there's some intersections. So let's just start with what is the European Union's foreign subsidies regulation, or what is being referred to as FSR, because I think it's really important for any multinational organization to understand what FSR is.
Right. Well, Doug, it's a great question. I mean, just to sort of reiterate some of what you said, or reinforce it, I suppose, there is a huge bandwidth problem at the moment. There's no doubt about that. No, I mean, you talk about Pillar 2 taking up all the bandwidth. Unfortunately, before Pillar 2, there was Pillar 1, which meant that people didn't pay attention to Pillar 2 until a little after they should have done. And now we're in a similar position with a number of other things which have come along, particularly from the EU. And if you look at the EU's tax docket, the files, the dossiers as they call them, there are a substantial number of them. There are over 10 which are active, and many of them will actually have a significant effect. The FSR is not actually a tax file. This comes out of DG Comp. It's the folks who look after to state aid and subsidies and issues like that. And in fact, this is what this is in a sense. The foreign subsidies reg is an attempt by the EU to essentially export the EU's state aid rules outside of the EU. It's interesting. It's a regulation. People say, well, don't they need a directive? And the answer is no, they don't. The legal basis for this flows straight out of the European treaties. And therefore, there was originally a white paper on this, I think in 21. They decided it at the end of 2022. And once they adopt the regulation, which they did at the end of 2022, it comes into effect 20 days after that, which I believe is January the 12th. And then we have this regulation which comes into effect, which actually bites, starting on July the 12th. And it's fully formed. It's relatively lengthy. It's relatively complex, and as I say, it builds on state aid rules, but it also obviously has some twists to apply that outside of the EU.
So I did a podcast several podcasts ago with Edwin Visser, really going through a number of those policy proposals and changes, and we really just touched on the FSR. But maybe if you could remind us,
right,
what is state aid? And frankly, I think many of us just haven't been as focused on that over the last few years, and there was certainly a number of litigation, but really, what is state aid, and then how are those concepts used for purposes of FSR, and what are some of those? What are the consequences?
So, state aid essentially is the EU's attempt to protect the internal market, which is to say that inside of the 27 countries of the Union, that all businesses are on an equal footing. So, it's an attempt to prevent countries giving subsidies to favored corporations, including state airlines. That was one of the things which tends to come up. But also to ensure that certain sectors don't get advantages over other sectors. Now, there are some exceptions for example, for R&D type activities. But for the most part, it is relatively strictly enforced against national governments and against corporations. And the concepts that they're building on here is that other countries equally don't give businesses advantages outside of the EU to then come into the EU and take business from EU businesses which can't sort of access those. So there is now quite a body of law on what constitutes state aid. This is the majority of what the DG Competition Directorate, not the Tax Directorate, but the DG Competition Directorate does. Obviously, we've heard about it more in relation to tax, in relation to certain U.S. corporations which have received tax advantages. But that's what this does. It looks outside the EU. It says, has a business been given an advantage which then enables it to come into the EU and do certain things? We'll talk about those in a second. On a more advantageous basis.
So what were the consequences for under the state aid rules if a particular country gave state aid versus what are the consequences under these new FSR rules?
Yeah, well, it depends. There are different ways of doing it. it can be related to mergers and acquisitions, so you can prevent the merger from going ahead.
Under the FSR rules?
Well, also under state aid. But equally, more commonly, in that, firstly, they'll shut down the subsidy. Secondly, they may require the repayment of the subsidy. And again, that carries over into FSR, what they call redressive measures. But essentially what it does is, what the FSR does, is it looks at what they believe are incentives which could distort the internal market, particularly in relation to two things. One is M&A, and the other is public procurement.
Right, and so my understanding is that the Commission can exclude non-EU companies from engaging in both M&A deals or public procurements. Obviously, the EU does not have the authority to be able to shut down these type of what they define as financial contributions outside of the EU, unlike state aid.
Right.
And so that, I think, is really one of the fundamental differences, is that really the mechanism by which the EU can potentially enforce that is calling off deals or potentially preventing the engagement of certain public procurements, which seems like a pretty big deal.
Well, yes, except it can go broader than that as well. I mean, there are two important things to remember. The first is, and again, we'll get to this again, I think, a little later, is this does not just apply to non-EU headquartered businesses. This actually applies to EU businesses as well, if they have business operations outside of the EU, which also get the benefit of these subsidies, because that then gives them advantages against other EU entities which might not have that. In terms of what they can do, yeah, sure, it's preventing the M&A from taking place. It's essentially ensuring somebody doesn't get the public procurement, but there are things well beyond that. As well, they can require the repayment of the subsidy in certain cases, and this will be familiar to folks who know some of the tools that they have in the technology company area. They can actually require access to networks, for example, which have been built with the advantage of these benefits. So they have very, very broad powers, very broad powers.
Okay, so let's unpack some
Sure.
of these. And first wanted to just make listeners aware of the effective dates, and then particularly notification and this whole pre-notification requirement, and just really the compliance that's required. So we already mentioned that the laws in force already as of January 12th, 2023. and applying from July 12th, 2023.
Right.
So I want to state that again,
Yep.
because I think that has snuck up on a number of us, that these rules are effective from July 12th, 2023.
Which is not so far away.
Right. And by the time we get this published, may already be after.
Right.
And so very, very timely. So talk a little bit about the pre-notification and the notification obligations. And so generally, what should taxpayers be thinking about with respect to how do they need to comply, so to speak, with these particular rules, and what type of information do they need to keep and share?
Right. Well, the type of information that they need to keep and share is almost anything which could, and again, we'll get to the definition in a second, which could be deemed to be a financial contribution, which is to say a subsidy or incentive. And it's important to note that these can be very, very broad. I mean, if you look at the regulation, I mean, we think of tax incentives, okay, we know what those are. We think of subsidies, we have a pretty good idea of what those are. But there are other things as well. I mean, for example, it turns out that buying electricity or gas from a state-owned company could count as a financial contribution. Now, obviously, you assume that that's not going to be in unless maybe it's subsidized for some reason. So, I mean, this can go very broad. From the, if we think of this from a U.S. point of view for a second, we obviously have taxes at the federal level, which include incentives. We have taxes at the state level, which certainly include incentives. But we then have, you pick a number, nobody can ever seem to decide, but maybe 10,000, 12,000 local taxing jurisdictions who can give property tax rebates and various other things.
Municipalities and states
absolutely.
and cities, absolutely.
So, very broad. So people need to be thinking about collecting that. It goes back 3 years. So it's going to be, very difficult, I think, for people to collect that. I think the Commission accepts that. I think they understand that a lot of this information is going to be quite hard to pick up. But then, in terms of notification, when you know that the deal is going to happen, when the deal has happened, likewise when you're engaged in the public procurement, you have to put in a notification then. When you think, or when you believe, when you're planning for there to be M&A, you can pre-notify at that point. The Commission has undertaken to commit a sufficient number of people to this. I can't remember exactly how many it is, close to 100, maybe more than 100. The rumor is that they're having difficulty filling those positions right now. So again, how this will go right at the beginning is unclear. But there is this absolute requirement to notify. And the penalties for not notifying are also very substantial. This is where you come up on the, there's whatever, is it 10% of worldwide gross revenue? It is a substantial number.
Yeah, we'll come back to that.
Yeah,
but
yeah,
I'm just, if people weren't paying attention, the
That's
penalty
right. Pay attention.
is 10% of
Right.
global revenue
Yeah.
for failure
Yeah.
to comply with this.
Yeah.
And so my understanding is that the actual notification applies from October 2023.
That's correct.
And then the point you made is that there's the pre-notification that can be for the past 3 years.
Right.
And then my also understanding is that the investigations can go back, I think, back to July 2018. And so how does that work as we just think about maybe help explain a little bit kind of the pre-notification and the fact that some of these investigations could be retroactive?
Right. So again, what we hope is going to happen and understand may happen is that there will be a bit of a rule of reason here, because otherwise, people would be backing trucks up to the Commission and just sort of dumping huge amounts of information on them. And I don't think that would be terribly helpful to anybody. What the Commission has said in the regulations is that there are a number of categories which are particularly most likely to distort the internal market. So one is a foreign subsidy granted to an alien undertaking, so think a state airline, for example, or indeed heavy manufacturing of some type. That's one type. A foreign subsidy in the form of unlimited guarantee for debts and liabilities of the undertaking. So again, that's support for essentially a non-competitive business to carry on. An export financing measure, which is not in line with the OECD arrangement on officially supported export credit. So that does not mean every export credit, although there may be WTO issues, and there is a WTO interaction with the foreign subsidies reg as well. Foreign subsidy directly facilitating a concentration, which is to say M&A, and then a foreign subsidy enabling an undertaking to submit an unduly advantageous tender on the basis of which the undertaking could be awarded. So, these categories actually narrow it down quite a lot. And what we think is that the Commission is going to focus on these. And indeed, there are some rumors going around, which may have been confirmed by the time this comes out or not, that actually the information which has to be notified and reported will have to be detailed in relation to those categories, but may be aggregated in relation to the other categories. And indeed may be aggregated in a sort of, we can talk tax for a moment, a sort of CBCR type of sense, which is to say it doesn't have to be tallied precisely. So, it may be that there's more of a rule of reason there, but even that having been said, even if you look at those categories, you're going to need, if the item that you receive is very large, you're still going to need to convince people that you haven't gotten an advantage out of that. So, we can see some potential narrowing, but nevertheless, people need to be very aware that they need to try and collect this thing. And in terms of looking back, obviously, again, as I say, I don't think they're going to ask you to look at every property tax rebate you've got, or sort of check the gas bill to check that there wasn't an implicit subsidy in there. But with some of the larger items, yes. And it's also important to note there is one other thing that they can look at. And again, these terms are not, you have to be sort of into the EU stuff for these terms to make sense. But in addition to M&A and to public procurement, there is also another which they call ex officio investigations, which essentially means investigations that they can start on their own. And they can look at pretty much anything that they want to. Wow. So if they see large subsidies in a country which are attracting, I don't know, sort of battery makers, for example, or something like that, then they can launch an investigation into that and they can ask for information. You were talking earlier about being able to investigate inside the EU and outside the EU. They can do that. They have to have an arrangement. They have to have asked permission essentially from a non-EU country if they want to carry on those investigations outside the EU. But in certain cases, that may be forthcoming. So again, very broad-ranging, hopefully narrowed slightly, but we don't know yet.
All right, so I'm going to ask some questions that I think most of our listeners, particularly in the context. So what you've really been talking about is the definition of a financial contribution.
Absolutely.
And that is the terminology, the kind of the term of art that's used in these rules. So, there are a lot of deals that involve U.S. entities, right? Yep. Whether a U.S. is a subsidiary with a non-U.S. parent, whether it's a U.S. parented group, pass-through, whatever the case may be. One of the really big incentives that we frankly have spent a lot of time talking about on this podcast, more in the context of Pillar 2, is the Inflation Reduction Act.
Indeed.
We also, obviously, in the U.S. have foreign-derived intangible income. That generally applies to exports, for example. Do we have any thoughts, or has the EU provided any guidance on two of these common areas of the tax law in the U.S., the green energy credits from the Inflation Reduction Act, or FDII, I mean, that's just to name a couple. Any thoughts on how the EU may view those types of regimes in the U.S.?
Yeah, I mean, so it's really interesting because, as you know, there's been quite a lot of political fuss, in particular, about the IRA. Although the Europeans the European Union has now, or European Commission has now come up with its own ideas on green subsidies as well. There are sort of mixed signals being sent here. Apparently, a European Union official was talking about this a few weeks ago and said, "Don't worry about the Inflation Reduction Act." He said because that's not dealt with by the FSR because there's a carve out, as I was saying earlier, for things which are dealt with under the WTO, the countervailing measures and subsidies, ACSM, I think it's called. So don't worry about that. That will be dealt with under those WTO procedures instead. And as we know, the WTO isn't working at the moment because it doesn't have an appellate body.
Right.
It's not clear, however, that's correct, because what the WTO, if you look at the ACSM, what that deals with is export-related subsidies, essentially, support. And the Inflation Reduction Act is much more about, hey, come here, do it here.
Right. Which could be differentiated from really the foreign-derived intangible income, which directly applies to exports, for example,
so,
amongst other things.
That's right. So, FDII clearly also inside this, potentially. But again, going back to what I was just talking about, it does seem that if that is not directly linked to one of these 5 areas which are quote unquote most likely to distort, then maybe it won't be in. So you'd have to keep track on it. And the one thing, just let me be very clear about this. Nothing that I'm saying about the possibility of aggregating this information does not mean that you don't have to collect this information, because they can come back, and if you don't have it, retro collecting, if I can put it like that, is going to be enormously hard. So there is still a big incentive to again, to improve process. I mean, this is a sort of part of the Pillar 2 discussion.
Right. It's just, this is a whole nother just
Yep.
compliance process
Yep.
and query whether it sits somewhere between tax and legal, right? And we talk a lot about Pillar 2 sits somewhere
Right.
between tax and data and all the information that's needed. Just another really challenging compliance requirement.
Well, that's an interesting point, because I've had a number of clients say from tax departments say, "Hey, is this ours?" To which the answer is, well, it's not completely yours, because there's legal, there's business development, sure, there's finance, there's going to be accounting,
Supply chain with the potential public
that's right.
procurement.
Supply chain, all of these things. So there's going to have to be a cross-business, organization, operation, effort here. But I also say, in the end, quite a lot of this is going to come down to the tax incentives. And therefore, you need to be really heavily involved in this. And of course, then there's the old thing about, if everybody owns it, nobody owns it. So somebody probably has to own it. But it is going to be a complicated thing, because, as with, go back to country by country reporting for a moment, not all taxes flow into the tax department. The property taxes may well show up in, sourcing or wherever it is. Electricity prices will show up somewhere else. Taxes, utility taxes, those types of things will show up somewhere else. So it's going to be hard to pin all of this stuff down. But it is also, I think, unfortunately, going to be really important to do that.
Yeah, and it feels like without additional guidance from the EU, even with respect to the Inflation Reduction Act, which, you can, I think, make strong argument is not an export type subsidy, and even FDII, that given the potential substantial penalties that we discussed, again, 10% of top line revenue for a company that could potentially be at stake, that you would guess the taxpayers would want to take a very conservative of approach.
Right.
And then to your point, it's just like, where do taxpayers draw the line in trying to collect this information?
That's right. And, one thing that I've heard recently is that while we're expecting what they call implementing regulations, which is to say how to do the notification procedures, all that type of stuff, we're unlikely to see major clarifications for at least a year. So, people will be left to essentially get on with it. And what the regulation says is that they will decide what's distortive and what's not. And one of the few advantages of essentially backing the truck up was, okay, well, it's on them to decide what's distortive and what's not. If they go sort of with this narrowing, so just looking again at these, the most likely to distort, that actually puts that back onto the business to decide what is and what isn't. So that actually raises a different set of issues. And some of this stuff, again, is related to state aid rules, is related to merger control. So, particularly for non-US for non-EU headquartered businesses, very close coordination between EU experts and those businesses is going to be very important, because it is going to be almost impossible for somebody who is not into the EU process to understand what distortive might mean under those circumstances. So, even a narrowing is, comes with challenges.
Yeah, I know one of the questions that's been floated out there, just as another example, is this idea of qualified refundable tax credits, kind of the above the line, so to speak, incentives as opposed to the below the line. So as we, compare the R&D credit, for example, in the U.S., which is non-refundable, versus the refundable R&D credit that is refundable in the UK. Right. Is there any distinction that's made between those, or?
No, and I asked somebody about this in a foreign government a week or so ago, and the guy just shrugged and said, well, the right hand doesn't know what the left hand's doing. And, I think that's the case. Undoubtedly, all types of tax credits which provide a benefit would have to be recorded, whether or not they're quote unquote good for Pillar 2. Whether as a practical matter that makes a difference, I don't know. One of the interesting points is that if you look at state aid, for example, one of the biggest issues that we have in the US with credits in Pillar 2 is the R&D credit. But actually, strangely, well, not strangely, under the foreign subsidies reg, the R&D credit might not be an issue, because one of those exceptions from state aid is for R&D support. And therefore, you might have a credit which is bad for Pillar 2 and good for the FSO.
Okay.
You following this?
Yeah, the tangled webs we weave.
Indeed.
All right. So wanted to just spend a little time talking about some of the consequences. So we already mentioned that if parties fail to notify a notifiable transaction or breach other obligations imposed by these rules, that the commission can impose a fine of up to 10% of their worldwide group turnover in the preceding financial year. So it is at least last year's earnings that they make that determination. And but there are other broad sweeping powers. They could potentially block a deal, prevent a company from participating in public procurement, impose repayment, behavioral remedies, or divestments, which you mentioned earlier, or require companies to change their governance structure. Any insight on, frankly, any of those? And from a practical perspective, I mean, you had mentioned that they're already trying to hire people, but I mean, this just seems like such a massive undertaking with significant consequences that it kind of begs the question from a practical perspective is how is this going to be enforced?
It's a great question. And I fear the practical answer. I'll come back to that a little later on. One of the things that, one of my understandings about this is that it would prove very hard at this point to change the regulation itself. But what they will try and do is within the regulation itself, when they come out with these implementing regs, that they will try and use some of the wiggle room that they have to make this easier. So they can raise and lower by some percentage some of the thresholds, for example. And they may also be able to do other things interpretatively. But they are where they are, and as I say, they may be able to narrow the amount of detailed information that you actually have to report. My guess is, as a practical matter, that they will only go after what they view as really egregious cases. The egregious cases they go after, I suspect that they will go over with a fine-tooth comb, however. And obviously, the intention of many of these rules is not for everything to be investigated. It's not for everything to be looked at in excruciating detail. However, it is to do enough of that to encourage everybody else to do the reporting that they need to do so that there are essentially some examples made. And while I expect there to be a sort of soft start to this, undoubtedly where they see what they regard as particularly troubling subsidies and incentives, they will go after them. And who knows? I mean, one of the interesting things to if we come back in 3 or 4 years' time, one of the interesting things to see is actually how many M&A deals, how many public procurements did they disallow, versus actually how many of these ex officio investigations have they undertaken and then taken action on the basis of that, because many of the redressive measures are really most aimed at these ex officio investigations rather than in the M&A and the public procurement, where it's a simple, sort of yay or nay. So we could actually see more action there.
Yeah, and like on the large public deals, which need other types of regulatory approval of the EU or the US or wherever the case may be, I mean, there's lots of smaller private deals that get closed very quickly. And another practical question is how quickly does that review take place?
No, I mean, that's a great question. Again, they've committed to doing this fast, but even then, even some of the timelines which are in the guidelines, which look short in one sense, maybe an eternity in deal space. And one of the things that people have been talking about, in the private equity space, for example, is that some of these notification requirements, obviously, they're not deal specific. They're actually across the entity. So there may be lots of reporting which is constantly being required in groups which are highly acquisitive, highly dispositive for that matter, and exactly again how that's going to work is unclear, because sometimes, as you say, the timelines are very, very short on this, and it's unclear at the moment that the Commission is going to have the firepower to be able to do all of this stuff. So again, they may need to come to some type of rule of reason on it.
Right. And you had mentioned, and we'll state again, this is relevant for U.S. parented groups, Asian parented groups, EU parented groups, if they have some sort of presence in the EU. right, to obviously subject themselves to EU law.
Sure.
But what types of groups could potentially be impacted, right? This is more than just, publicly traded multinationals.
Oh, sure. No. I mean, this is. There are size requirements in this, and there's one of them requires 500 million of revenue. Others are focused in the procurement side more on the side of the procurement. So I mean, you're not talking about small SMEs, but where you're talking about revenue of 500 million, you're obviously talking below the Pillar 2 level, for example.
Right.
It's
which we think is somewhere in the scope of 10,000 companies,
something like
somewhere
that.
in that realm.
So
of 750 million euro.
That's right. And again, if you look at the amount of as we see across what we do and as others see across what they do, the amount of this activity is substantial, even in a quote unquote quiet year. There are a lot of people. So it's not, as you say, it's not just large public corporations. It's also sovereign wealth funds. Mm-hmm. It's small corporations, private equity groups, anybody who's privately held but large enough. So a very broad range of businesses pulled into this.
All right. And so, just lots of challenges. We talked about just the challenges with enforcement and the broad application. Sure. But what steps should taxpayers take? I mean, how from a practical perspective, because we already mentioned the diverse group of stakeholders. And this, again, is a constant theme that we saw with Pillar 2 is that I think a lot of organizations and enterprises look at the international tax folks of just like, all right, well, this seems to be some sort of international tax. And this is not a tax law as you started off the conversation. This is, a trade, what I would refer to as a trade law or something that impact, again, deals and procurement. So what steps should taxpayers take to start to get ready for this, given that it is applicable July 2023?
Right. Yeah. I was going to say expand the day from 24 hours to 26.
Right.
Actually, I figured out the way to do this the other day because I had 2 invitations to the same call and I didn't know which of them worked, so I dialed into both. And I was there twice. And that actually solved many of my problems.
Which is challenging to do.
Which is challenging to do. But look, the answer, again, as with so many of the other things that we've been talking about, comes down to data. You have to have control over your data. And this is different data. And because, as we were saying, this can go down to very low levels of, different types of taxes and incentives. It's going to be, let's hope, as I say, that there is a sort of soft start to this. But it's getting, the collection mechanisms set up as soon as possible. And again, this is across the globe. This is not just in one country. This is across jurisdictions within a group. So, doing the best you can as quickly as you can do it. I think it's also, this is not meant to sound patronizing. It really is not, but take it seriously. Mm-hmm. Because this is not something that's happening over there. This is actually something big. And, you may think at this point, yeah, I do no business in Europe. Why would I care about Europe? I just don't need to collect this. In 3 years' time, if you're doing, if you see an attractive opportunity and you don't have this stuff, you're going to have you could have a really difficult time of it. So it's take it seriously. But again, just, maybe if you're already in the ERPs, sort of fixing it for Pillar 2, you just, you start adding this stuff as well.
Yeah, and I think, a lot of this information, frankly, may be outside to an ERP. The point just kind of actually shook me a little bit of like even multinationals that are not yet invested in Europe may consider putting some process in place to the extent that they could be investing in Europe or procuring from Europe or. So, it feels a little bit like Pillar 2 in the respect of there's an operational readiness component. Yep. Like we have to let the business people, the tax people or the legal people who are aware of this need to let the business people know. Right. So whether it's your deals teams, your procurement teams, others, and then putting that stakeholder group, so to speak, together is really probably one of the first priorities. Absolutely. And then to your point, then, all right, trying to take inventory of what could be considered a financial contribution, understanding, what the kind of technical risks are, what is, what's out, what's in, what's out, obviously could be a significant undertaking. I think from a practical perspective, companies are, given all of the other requirements, legal and tax requirements, frankly, are going to say, well, we'll deal with this when we have to. And the challenge will be like, listen, if a deal is closing in a short amount of time, do you have the appropriate information to apply these notification requirements, knowing that if taxpayers do not comply with the notification requirements, they have this massive penalty.
Right.
So
or just a no-go.
Or they can just, like on a deal, they can potentially squash the deal without the appropriate notifications. And then I think the other big challenge will be kind of coordinating between the EU experts, right, and then non-EU experts. So I can already imagine my phone ringing, trying to understand some of the various incentives that are offered in the U.S., and I use that word loosely, about whether they are considered a financial contribution, and then this whole point of things being covered by the WTO, that this is not intended to kind of usurp the WTO's, frankly, just adds a lot more technical uncertainty about, well, what should you include and what shouldn't you include, and given the situation with the WTO.
Yep. And then this question about, well, what is distortive? What fits inside of these categories? And, are they going to interpret that consistently? Could it change over time? And in some cases, that 10-year look back as well. This is a big deal. And it has, in part because it was a regulation, because, when they agreed to it, after not a huge amount of publicity, it was effective almost immediately. It's been very different from the Pillar 2 directive process, where we had a year leading up to the directive actually being agreed while they argued about it, and then we have another year while they seek to implement it. We have none of that luxury here at all.
Right. I mean, it feels kind of, stepping back for a moment as we kind of conclude today's conversation, that there is a war on tax incentives. Right. And from a policy perspective, I think one could argue that
it's almost ideological in a way, actually.
Right.
It is the idea that these things are bad. And, you see it in Pillar 2.
Right.
And you see it here. And I mean, in a sense here, it is at least better explained, which is that you're trying to level the playing field. It's just that leveling the playing field outside of the EU becomes a whole lot more complex because you're looking at the rest of the world. But yes, there are... yes, I think people are.
So it begs the question, Will, and I know the answer, but I'm going to ask it anyway. Does this mean that the competition for foreign direct investment is coming to an end, and the ability for countries to be able to try to compete for investment? And I love the example from a U.S. perspective, just because we see it a lot. That municipalities and cities, right, and states are constantly competing for that next big plant or that next big headquarter or that next big office. And that is obviously just part of how business is done in the U.S. as companies think about location choices for any type of investment. And then obviously that also occurs around the globe. And so are we going to see this stop now, for multinationals and across the globe?
I think I can say with total certainty the answer to that is no. Will it change shape? Yeah, of course it will. Right. Has it changed shape over the past 10 years? Yes. The past 20 years? Yes, it has done. And, I mean, at a certain point, this is a sort of maybe a philosophical note on which to end. Some countries have enormous advantages, their size, the richness of their market, already existing infrastructure, which allows them to essentially attract investment without having to directly incent companies. Other countries don't have that advantage. And, I think that we need to come back and consider exactly what the balance should be, because I don't think we have it quite right yet.
Yeah, and I mean, to just be very frank, I mean, the issue is for developing countries, they use these types of incentives. Yes. And we've seen this around the globe, how various countries have moved or are moving from developing to develop by attracting this investment.
Right.
And the point is that Pillar 2 and then now the FSR really disincentivizes or creates issues with these types of incentives and just creates another challenge for developing countries as they're trying to raise up their economies.
Right. To be continued.
To be continued. So, Will, a fascinating discussion, and it was really driven from that podcast that I did with Edwin, and I felt that, and I heard a number of comments from listeners on this FSR, kind of, hey, can you double-click on that?
Right.
And this seems like a big deal, and I've certainly spent some more time getting smart on this, and I know that you're always kind of have your ear to the tracks of understanding what's coming down, and so appreciate your wisdom, guidance. And this is certainly something we'll keep an eye on. And the implementing regulations, I think, are going to be very important. And to the extent that we have any EU policy listeners, hopefully they understand the challenges that taxpayers have with complying with this. And hopefully we see some favorable guidance in that regard.
I hope so too.
All right. Well, thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Will Morris, PwC's Global Tax Policy Leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.